Happy day, everybody, and welcome back to Mortgage Talk with Mark. For today, that's exactly what we're going to be talking about. We're going to be talking about mortgages, specifically for investors. If you haven't been on the show before or haven't seen me live doing this show, my name is Mark Hairston, and my company is Texas Mortgage Source. It's behind me there on that banner. I've been providing home loans in Austin, Texas for about 40 years now. So we're going to talk about some of the evolution of mortgages in some respects, particularly around investors. We're getting lots of calls in the last couple of months for investors. And to me, what that tells me is that prices have probably bottomed out, or maybe they're seeing opportunities out there that you can buy properties cheap, become financial straight. I want to talk specifically around how to buy where investors start stepping in, and because there's opportunity. That's what they do. They buy investment properties and they flip them and they hold them and they do all sorts of things we're going to talk about today. Even so much that in the last several years, what we're starting to see a lot of large corporations and hedge funds coming in and buying actually subdivisions of homes just for rent. They're just simply renting them out. They're not selling them yet. And I ran into a guy at the airport a couple of months ago. I was flying to Nashville, and we were standing in line to the security line, and he works for a developer here in Austin. They're actually based in Nashville, but they have operations throughout Texas, and that's what they do. They actually develop subdivisions just for rentals. They may have 300 or 400 properties that they're just renting out. So that's what I mean by follow the money. There's obviously some good money in residential real estate, short term and long term. So let's talk about financing. And when I got in the business in 1985, there was very limited. You had to have great credit. You had to qualify with income and that sort of thing. We're going to talk about how that's evolved over the last 40 years, certainly the last 20 years, and some different options for self-employed folks who may not show a lot of income, and how they can still participate in buying properties. But the most traditional way of buying a investment property, whether it be a single family home, which is probably the most common, but in my world, you can buy anywhere from a single family home up to a fourplex as an investment. You're not going to be living there. There's other strategies if you were to live there, but in this case, we're talking about somebody who has a homestead somewhere and they want to buy properties, and that doesn't have to be in Texas, but somewhere in the country. As an investment, they're going to rent it out. There's other ways we're going to talk about how to utilize those options. And typically, somebody comes to me, and I've done hundreds of these over the years. A client, let's say he's with Dell or he's with Apple, and he's an employee. He has great income. He's got great assets and great credit. And typically speaking, to get the best deal in the marketplace, these are going to be the best rates because they're going to be funded or insured by Fannie Mae and Freddie Mac, the secondary market, just like they would buy for owner-occupieds. But if you have good credit and you have 25% down, you're going to get a very attractive interest rate. Right now, and we're talking December of 2025, we're probably talking around 6.5 to 6.75 with 25% down on a single family home. Now, if you want to buy a duplex, the lenders may require you put down 30%. So it's a pretty big capital expense up front, but that's where we are today. And the reason is back in 2008, 2007 and 8, somewhere in there, we were doing loans, what they call the B paper loans or subprime loans at the time, where you could buy an investment property with zero down. Now, that was a nightmare because those loans, they all went to foreclosure. So the secondary market, it's really the federal government came in and made some changes, and they called it a QM. These are what they call QM loans. QM means qualified mortgage. A qualified mortgage has certain guidelines that we have to meet as a mortgage broker in order to sell that loan to Fannie Mae, as an example. Now, we're going to talk about in a minute about non-qualified mortgages. There's a whole second category of loans that investors use to leverage real estate, but they don't have to do all the bells and whistles we're going to be talking about initially. So if you want to buy a qualified mortgage through Fannie Mae, you're going to have to put down, again, 25%. So the pros are that you're going to get a better interest rate than a non-QM loan. But we're going to talk about some of the advantages of non-QM here in just a second. But typically speaking, a traditional Fannie Mae loan, 25% down and very good interest rates. Now you have to qualify based on your income and debt to income and things like that. So it's fairly strict way of going as well. And the other advantage is that these loans have no prepayment penalty. So if you want to sell it in the future, there's no penalty. Some of these loans we're going to talk about in just a minute do have a penalty or potential penalty if you were to pay them off early. So we're going to talk about that in just a second. So and also you're limited if you buy lots of properties. If you're somebody who has some cash available and you want to invest in residential real estate, Fannie Mae will limit you to 10 financed properties. So you can't have more than 10 mortgages in these pools with Fannie Mae. That's the cap. So if you're in a situation or an opportunity to buy lots of properties, then you're going to have to use some alternative types of investments we're going to talk about. So again, these loans are a little bit hard to qualify for, but they're something we do a lot of because a lot of lenders want these loans. These are usually perform very well because the people typically are going to be very well qualified. Now, non-QM loans are a second category. They've been around for a while. After the crash in 08, 09, 10, somewhere in there, the markets really shut down and got very conservative. It was very hard to get investment property loans on residential real estate. That started to open back up around 2014, 15, 16. And there's a category of loan called a non-QM loan. These loans are usually they're pooled by large corporations that loan on these properties, but their guidelines are going to be a lot different. So let's kind of talk about a little bit about the types of investment properties you can make. One would be, in somewhat typical one, is buying a foreclosure. Now, foreclosures, at least in Texas, is that every first Tuesday of the month, counties by county are going to auction off properties that have gone into foreclosures. People didn't make their payments, and the investors took them back. The lenders took them back. The banks took them back. Fannie Mae took them back. Somebody foreclosed on that property. And the first Tuesday, after they've given notice to the client who apparently can't catch up on their mortgages, they're called bank-owned properties. And every first Tuesday, every county, like Travis County, Williamson County, will hold an auction. And I've bought homes on auction before, back several years ago, and we've made pretty good money at that. And when I say auction, you actually bid on these properties. They're given a address, and there's maybe 50 people there, and somebody's going to bid on that, and the highest bidder wins. Okay. Now, the downside of that is you have to have cash. Those loans are not going to be financed initially by a mortgage company. You're going to have to bring your 100 grand or 150 or whatever it is you bid on. Now, I just found out today from somebody here at the radio station, which is news to me, there's actually a website called auction.com where you can actually bid online for properties too. I didn't know that. So that may be something to look at just to start exploring. If you're thinking about buying investment property, maybe your money's tied up in the markets and doing real well right now, but you're a little scared the markets may shift, and you want to diversify some of your income or some of your assets into real estate. Start exploring maybe this auction.com to kind of see what that's all about, or just go down to the county on the first Tuesday at 8 o'clock or 9 o'clock, whatever time it is, at the courthouse. It's actually what they call the courthouse steps. And they're going to be auctioneers out there. The trustees who hold these mortgages are going to be auctioning these properties off, and you may just watch how it goes, and maybe get your feet wet there. That's a way a lot of guys make pretty good money. That's what they do full time. They buy foreclosures, and then if you did buy a foreclosure like that and it needed some work, let's say they'd torn it up and they needed 50 grand to make it worthwhile to live in and sell. That's called more of a fix and flip opportunity. We're going to talk about those in just a second. But the pros around buying foreclosures is the fact that usually you can get a good deal. Okay. You can buy it way below market value because these banks, they don't want to fix them up and try to sell them traditionally. They just want to get rid of them off their books. The downside is a lot of times you haven't been able to see the properties, and you don't know what kind of condition they're in, or you don't know, you haven't had time to run title possibly on them. So there may be some liens on those properties that you're not aware of. As an example, the property that my wife and I bought several years ago, the HOA had a lien on it as well, not a mortgage on it, but the people hadn't paid their HOA dues up to $4,000. So that was something we had to clear. That was in addition to what we paid. So we didn't know that. So that was a learning experience for us, but we ended up fixing it up a little bit, and we made some money because we sold it. In hindsight, we should have kept it, but we didn't. We sold it. Foreclosures are a good way of going as well. Now, another more non-traditional way of financing properties. Let's say you find something in a neighborhood that's not a foreclosure; it's for sale on the market, or maybe you have a friend about yours who wants to sell a property and you want to invest in that property. You want to buy it as an investment. Another category of financing is going to be a DSCR, and these loans have been around for a while, but a lot of people aren't either not aware of them or they're not aware of how they work. So we see a lot of people coming in, and we're using DSCR as a mechanism or a financing product. People buy investment properties, and the guidelines are very much more lenient than it would be if you go to a conventional market trying to put down the 25% and all that. Now, you do have to have a down payment. Don't get me wrong. It's usually around 20%, but they don't qualify you based on your income. So what we see a lot of times is self-employed borrowers, whether it be maybe a subchapter S corporation or maybe a sole proprietor, and they make good money, but they take advantage of the tax laws and they write a lot of things off to keep their tax liability low. We see that all the time. Every week, I see this situation where somebody comes in and their tax, their income's fairly low on their tax returns. The SCR loans don't care. We're not even going to ask you for your tax returns or your W-2 of yourself if you're employed. We're only going to look at the property. And so the way it works is the property has to cash flow usually 1-to-1, which means at the end of the day, if your mortgage payment is $2,000 and your rent on that property is $2,000, then that's how they qualify you. Okay, DSCR, debt coverage service ratio. It's a ratio of the income on the property versus what your mortgage payment is. Now, some of my lenders don't even have a ratio. You don't have to have income on it at all, but the rates are going to be quite high. It's more of a non-traditional no-doc loan for investors. I don't recommend it because it's the rates can be in the 9s, and that makes it very hard to cash flow a property in the 9% in this market, at least in Central Texas. Now, you get out to Harker Heights or maybe even Temple Belton, certain areas you could still probably cash flow, but not going to be in Austin or Williamson County most likely. But that's also a very, very common loan, and there's lots of lenders, even more traditional lenders, who are getting into that space. So the rates are good. You can probably get an interest rate of, I would say, 7.25 on a 30-year loan. Now, they also have options where you could do a 5-year ARM or 7-year ARM, interest-only options possibly. So they're being very creative to help people buy investment properties because they're seeing opportunities that the general market, the secondary market is not addressing. Okay, so it's a niche, if you will, for certain companies, and there are lots of them that are doing them these days. The downside is a lot of them times are going to come to get the best interest rates. They're going to also put a prepayment penalty on these type of loans. So in other words, if you were to sell in the first 3 years or refinance in the first 3 years, they're going to penalize you. It's going to be a percentage of the loan amount. So be aware of that, because then the broker will tell you, it'll be all written out in the paperwork, but just be aware to get the best rates. You may have to agree to a prepayment penalty, which a lot of guys do, because these loans are going to be typically long-term holds. They're not necessarily a fix and flip like the other properties we talked about a minute ago, which is another category, which is fix and flip, where you see an opportunity to buy property, fix it up, and sell it. And that's I know a lot of people in Austin doing that. Certainly that was big time a few years ago, and it's starting to come back because prices are now reasonable again. And in this economy, we've seen a lot of people are hurting. There's millions of homes around the country that are behind on their mortgage payments. So people are still trying to get over some of the inflation we've had in the last few years and jobs and things like that. So there could be some really good opportunities to buy properties, either fix and flips or long-term hold. I've got 2 investment properties, and they're both long-term holds. One is what they call more of a midterm hold, where we keep that property furnished with our furniture. It's not Airbnb. We'll talk about that in a minute, Airbnb. But a midterm hold is a single family home. In this case, is a condominium that we own, and we keep it furnished, and we rent it out at least for 30 days. 30 days is the minimum contract because it's not Airbnb. We don't have to have any kind of approval by the county or the state to no licensing, if you will, to rent that property out for 30 days. That's considered a long-term lease. It's called midterm because a lot of our tenants are only there for 3 or 4 months. It's temporary. It's like an Airbnb because it's furnished, but it's not necessarily overnight. These people are in transition possibly, or our client right now is getting divorced. He needed a place to live. He doesn't have a lot of furniture, so he's renting from us because it's turnkey. You walk in, you turn the TV on, that sort of thing. That's called a midterm rental. The other property we have is a long-term rental where it's vacant. That's a year lease. They come in and put their own furniture in there, just like a traditional rental house. That's called a long-term lease, and that also performs very well. So the pros of the getting back to the non-QM function around DSCR and bank statement loans. Bank statement loans is another option to where let's say you're making pretty good money, but you don't necessarily prove it on your tax returns or show it because you have write-offs. A bank statement loan is going to be one where the lender will look at your business bank statements and or your personal bank statements for 12 to 24 months. They average your deposits into your business, and they give you a percentage of that as your income, monthly income, I should say. And they qualify you based on that number. That's called a bank statement loan. That's just another way of doing it, where if you want to buy a property and you don't have any rent on it, they don't care because they can prove that you've got income, even though your tax returns don't show that. So again, if you're a business owner and you have really positive income coming through your business, and they average it over, small businesses typically have up and down, not every month's going to be the same. So you average them over 12 to 24 months. And based on that, you can qualify again with 20 to 25% down. All these loans require a fairly large down payment. That's because that's the security for the lender. They're not qualifying in the more traditional sense. So they want a significant position, if you will, on those. So the other type of loan that we do a lot of is, well, at least in the recent past, we not so much, but a couple of years ago, we saw a lot of people flood the market, especially in parts like Galveston. Galveston is full of these Airbnbs where people would come in and buy a property and rent it out overnight or long weekends and things like that for a premium. Obviously, I've stayed in Airbnbs. Most people have stayed in Airbnb, and they're still very viable. But that market's been hurt a little bit since the COVID days, because during COVID, a lot of people are moving around. There's a lot of people just traveling because there's nothing else to do. So there was opportunities for people to make good money on Airbnbs. And a friend of mine actually manages Airbnbs here in Austin. And if you're interested in talking more to him on the management side or what that would look like, and I could be happy to share his information with you offline. So let me know about that. But Airbnbs, I personally stay away from them. I think they're high maintenance because there's a lot of turnover in terms of cleaning and booking, and people don't take the best care of properties when they're only there for a few nights or maybe a week. So it can be a little more not dangerous so much, but a little more risky to buy Airbnbs, especially in this market, because Austin's still a very attractive place for people to come, but not like it was a few years ago. There's just not as much movement of people. So Airbnbs, we also do those. We have lenders who like to loan on Airbnbs. So if that's something you want to explore, give me a call about that. So the other con around that is getting bookings. My buddy Kenny, who manages these, and he manages somewhat high-end Airbnbs. Typically, you're going to be looking at $200 to $300 a night Airbnbs. He likes to see a property at least generate $4,000 to $5,000 a month for him to take care of these properties. And he's seeing not nearly as much demand. So that's the con on that. And a friend of mine who bought some properties in Galveston, she's had to sell them because they just weren't making money. In Galveston at one time, like a lot of places, was a hot commodity. And from what I understand, having done some loans down in Galveston recently for people buying properties to live in, it's somewhat flooded right now with Airbnbs on the market for sale. So that may be an option because, people, whether it be the coastal market like Port Aransas possibly, or Galveston, there's still very popular places for people, particularly in the summer. So that's another option on that. Now, when it comes to selling properties, there are some tax advantages to owning investment properties. At least I know for us it is, because one of the keys deductions you're going to get is what they call depreciation. So let's say we have our home and we make $30,000 a month on rent, or $40,000, whatever that it is, and the property's worth $500,000 and it cash flows and we're chugging along. When it comes tax time, we can deduct certain things that you may not deduct if you live there. The interest on the mortgage, the taxes, of course, any improvements you made on that property, any management fees you may pay on that property. You can also depreciate the property. That's one tax advantage of investment properties you will not see on homesteads. And that saves us probably, my guess is, even on 2 homes, that probably saves us about, I don't know, a couple $1,000s a year in income taxes, because we can depreciate our properties. But when it comes to selling them, the other tool that a lot of people use is a 1031 exchange. I've had an attorney on here a couple of times talking about just this strategy, where we wanted to sell our home, and let's say we had a $300,000 capital gain on that investment property. If we sold it and we took the cash, you're going to have to pay income taxes, or I should say capital gains taxes on that gain, which is fine. And then the cash, whatever's left over, is yours. Or through an exchange called a 1031, you can reinvest that money, taxes on, you're reinvesting that money. But let's say you want to buy some in San Antonio, or you could buy more than one property, 2 properties or 3 properties with your capital, with your gains, and not pay any taxes on that. It's a pass through until you sell properties down the road. So that's the other very positive thing about investment properties. The government wants you to invest in real estate, or other things too, but certainly in real estate. So they give you certain advantages to that. And then so make sure, I'm not a CPA, by the way, so I want to be very clear. I'm not giving any tax advice here, but because I'm simply not. I just know some of the basics on how these things work, because I own properties. We've bought properties over the years, and we've bought fix and flips, we've bought Airbnbs, we've bought foreclosures, we've bought midterm rentals. So I'm somewhat experienced in that world, and we're starting to see a lot of people come out in the woodwork right now, because interest rates have come down some. And not a whole lot, but a good point and a quarter from this time last year. Last year in the fall of 24, rates were 7 or so. Now they're closer to 6, at least for owner occupied. For investments, you're probably still looking at 6.5 to 6 3/4. But with a significant down payment, it may be a great way to diversify your portfolio if you want to tiptoe into real estate, because I think it's a good time. Let's see. The other downside of that, my experience is, in talking to a lot of lenders, I'm in a couple network groups that just work with investors. This is what all these people do, and they talk about, and they network, and they share ideas. And one of the things we've seen, though, is 2 things. Number one, rents have come down from the highs a few years ago. I would say to the tune of probably 20%. So if you were getting $2,500 on a rental property today, it may be $2,000 for that same home. Now, that's not across the board, because there are pockets that are still very popular and do very well. And the other thing that people fail to really budget for are home improvements, because tenants are going to be pretty needy, and you have to take care of the property more so maybe than if you live there, because you've got somebody that's paying you rent, and they want things taken care of. And a lot of my counsel with young clients who want to buy their first home, and the buy is to live there, is to make sure they understand the budget of what it takes to maintain a property, with ACs and heating systems and roofs and electrical, plumbing. There's all sorts of things that happen, or that you can buy warranties to help you offset some of those costs. But investors right now are saying, it seems like there's the cost of maintaining a property has gone up probably 20 or 30% over the last few years. So that's been a very negative thing. So when it comes to let's see, we've talked about depreciation, 1031 exchange, types of financing, types of properties to buy. The other way that people can buy investment properties, and this is something most people don't think about. I talk about it sometimes with younger folks, because it's a good opportunity to help them to buy a property. Let's say a duplex. It's called house hacking, to where if you buy a duplex and you live in one side of it, let's say your mortgage payment is $3,000 a month, but you're getting $1,500 a month on the other side, on the other side of the duplex. then your payment's obviously effectively 150, but you're leveraging an asset because somebody else is helping you pay it for it, but they're not on title, they don't own it, they're a tenant next door or a fourplex. My son will be doing the same thing. He has a roommate currently. They have a nice condominium in South Austin, and they pay about $3,500 together to a landlord. They're renting this place. I told Reed, I said, look, we want you to buy a house. He's qualified to buy a house, and his roommate will come in. They like each other. They're good roommates, and he'll come in and rent a room from him for $1,000 a month. Well, $1,000 a month, that's going to cover a lot of things. It's going to cover your insurance, and it's going to cover, expenses, cable bills, all sorts of things, mortgage payments, et cetera, et cetera. So that's called house hacking. So if you're looking for more information on this conversation a little bit, give me a call at 512-789-6967, or my website's just my name, markhairston.com, HAIRSTON.com, and I'd be happy to share my experience personally and helping a lot of other people buy homes to invest in. And